Hello, and welcome to the Logistics Management Podcast Series. My name is Jeff Berman. I'm the Group News Editor for Logistics Management Magazine and also the Peerless Media Supply Chain Group. It's a real pleasure today to welcome back Matt Muenster to our podcast. Matt serves as the Chief Economist for Breakthrough, based in Green Bay, Wisconsin. Breakthrough is a provider of fuel and freight solutions for shippers. Matt's areas of influence span from forecasting both fuel and freight markets to quantifying global risk factors and connecting macroeconomics with the everyday experiences of shippers through research industry data and understanding of market fundamentals. Matt informs actionable strategies for some of the world's largest brands, and his expertise has been utilized in a variety of different publications, including, of course, us here at Logistics Management, as well as Bloomberg and many other media outlets. Matt has a master's in economics from Bowling Green State and a bachelor of arts in communications from St. Norbert College. Matt, welcome back.
Thanks, Jeff. It's my pleasure to be on. Grateful for the invitation.
Yeah, absolutely. I was looking at my our podcast data, and I think this is your third time back. So you have the hat trick, which is particularly timely given that today is the USA Canada Championship hockey game for the Four Nations. So I just thought I'd throw that in there for the hockey fans listening in. Um, so Matt, why don't we just kick in where we usually do, and that would just simply be I'd love to get your state of the current state, that is, of the freight economy. Obviously, a lot of moving parts there, but I'll just sort of pass the ball to you, and I'd love to hear what you have to say about it.
Thanks, Jeff. A great place to start. I think the state of the freight economy is an interesting one as compared with the state of the broader U.S. macroeconomy. When we look at the high level numbers for the U.S. macro, we see such figures as 2.8% annual GDP growth from 2024, at least from the advanced estimate at the end of January. We
Hmm.
had 2.3% growth in the fourth quarter. We see a labor market that's still tight. We have an unemployment rate right sitting around 4%. That's been healthy. We still have real wage growth. So wages are growing at a pace that exceeds the rate of inflation. And while inflation has moderated, we do know that it's been sticky and that in recent months it's been stickier, and then be an expectation moving forward is just like it's difficult to shave those last hundredths of a second off of a sprinter's 100-meter time. It's going to be difficult to shave the tenths of a percent off of a headline and core inflation
Yeah.
as we move into 2025. So that kind of lays the state of the broader macroeconomy, that when we think about these broad set of indicators, overall, you should be pretty pleased, really, with the state of the economy. We just know that's not how the freight market feels, nor has felt for over 2 years, simply because there's an imbalance between what's being consumed and really driving the broader economy and what needs to be consumed to really drive the freight market. And so when we're thinking about the state of the economy at Breakthrough, we manage the movement of goods for shippers who create about 32 billion in transportation spend annually. When we're looking at the state of their shipments on a year-over-year basis, what remains left out from the broader freight market tends to be along the lines of durable goods, particularly equipment, machinery. The inflation that's bleeding through into new and used vehicle sales is showing up. We see slower movements of goods for automotive vehicles and parts. We're still seeing the high interest rate take its toll on the housing market. And ultimately, we're seeing slower freight in building supplies. And so what's missing for a really healthy freight economy right now is that demand that we're seeing in retail, consumer packaged goods, in paper and packaging just isn't showing up everywhere in the freight market. We have imbalance, and so we have this disconnect between what's going on in the macroeconomy in the U.S., relatively healthy figures. I mean, we should be thrilled to see 2.8% annualized GDP growth. That's excellent, well exceeds the longer term trend from 2000, for example, being closer
Hmm.
to 2.1%. But in the freight market, we haven't pulled out of the trough that's led to lower demand or lower total shipments for truckload and intermodal freight, and ultimately lower rate environment because capacity has remained in the market.
Yeah, absolutely. Um, So Matt, obviously the big talk obviously has been really going back to the inauguration in logistics circles. Really centers around tariffs. I mean, it seems like day after day we see a new news item, an executive order, or some other development related to tariffs. When I was preparing initially for this last week, I thought reciprocal tariffs would be the most recent tariff action we might discuss, but now obviously we've seen the White House talk about possible 25% tariffs on autos, chips, and pharmaceuticals, and among other things. Also, oh yeah, steel and aluminum from last week. Additional 10% tariff on China items. I mean, where to begin? There's so much tariff talk. We could have probably made this whole podcast about it, but I know it's pretty open-ended. But just on a general level, how do you kind of view what's going on sort of at this rapid clip as it relates to tariffs?
Excellent question. You certainly can make many podcasts about tariffs right now. There are plenty of them going around. They try to be a sponge for information. To your point, it's difficult to keep up with the pace of change. So I have that empathy for fellow transportation supply chain practitioners.
Hmm.
A couple things that I'm really focusing on and trying to come up with a judgment of what's going to persist, what's not. I think we can learn a couple things from the first Trump administration and ultimately the several years that have followed as a guide. And so recently we've had a couple more developments. You talked about them. We have the 10% tariffs that are added to Chinese goods on top of existing tariffs. Tend to expect those to remain in the market. That Chinese tariffs going back to end of 2017, 18, they kicked off, have lingered through two administrations. I tend to
Hmm.
expect that pressure to remain in the market. Uh, Over the longer term and their impact, we have seen a slowdown in the amount of goods, the value of goods coming from China as a consequence of that. It has meant that we need to pull more goods from places like Mexico and Canada. And so whether the postponement or the pause on those 25% tariffs for Canadian and Mexican goods persists past March 4th is of particular interest. A couple of things that we're mindful of in providing uh, transportation stakeholders with guidance and estimates and foresight for. We had a real brief experience with those tariffs in place going back to, I believe, the third of this month. That on that Monday, we are observing what was happening in the energy market. We are particularly invested in that space because of the tariffs that were being levied on Canadian and Mexican goods. We were particularly focused on the crude oil coming from Canada and ultimately its impact on refined products in the United States. 4 million barrels of imported crude oil a day comes from Canada. Much
Hmm.
of it comes into the Midwestern region of the United States to refineries and can have an outsized impact on that region. And what we're seeing in the daily movement of commodities, just on that one day of the sample size that we have to work with, was we were seeing tariffs being shared both by the Canadian crude oil producers and ultimately the American refiners that depend upon it to create our gasoline, our diesel to move goods to market. So that's something to keep in mind that when we're looking across the commodities that are heavily influenced, should those March 4th tariffs take effect, the energy market can be impacted. So on that first Monday of February, we saw diesel prices in futures market increased by 10 cents per gallon. It's not inconsequential. Expect tariffs in Mexico to have an impact on the auto industry. I mentioned that industry already has challenges with its sales that are created through a higher inflationary environment. And we look across sticky inflation rates, new autos, used autos, auto insurance. Those are all line items that really stand out in terms of sticky inflation.
Hmm.
We know those executives went to Washington. They're obviously concerned about prices being passed on to consumers. So those are some can't ignore circumstances that can still come out from the 25% tariff increases. And then the other industry that I think certainly doesn't want them to go into place as home building. It has enough headwinds with higher interest rate environment. It was a drag on Q4 GDP, so we had really strong consumption, especially led by services, but non-durable and durable goods fared very well too, and durable showed their third quarter of increase. We had drag in private investment, especially with new construction of homes, residential homes that goes into an investment, and also business investment in capital. And so the last point I want to make here before circling back to the question is, where do I think the tariffs are particularly harmful in terms of the broader freight market? I really think it's business investment, because ultimately it creates uncertainty to
Yep.
make the kind of investments and the things that are already slowing down our freight market, like capital goods. So increasing that cost of capital further, whether we're talking about structures, equipment, tech investments, it's something that businesses are mindful of. There are other economic headwinds like interest rates that they're mindful of right now. And so just adding the uncertainty of tariffs into the market isn't going to help us if we're aiming for more freight volumes in 2025.
Absolutely. And the uncertainty component is a great point. And I feel like I'm hearing that word almost daily in conversations with industry stakeholders. Um, but prior to the inauguration, and still now to a point, Matt, obviously we've heard a lot about the terms pull forward or front loading, efforts on behalf of BCOs, shippers to get ahead of tariffs. What is sort of the stop and start nature of these kind of, I don't want to, tariff, pending tariff announcements, threats, whatever they want, however they want to be viewed. What does that do to the shipper's mindset when they're thinking about taking steps like front loading or pulling forward?
It's a great question. I can't say from our ecosystem of data, and granted, it's not representative of the full economy, although it is a very uh, good slice in terms of uh, 200 plus shippers who tend to be of a Fortune 500 footprint, moving consumer packaged goods. They're retailers, they're durable goods manufacturers. We look across our ecosystem, we hadn't seen a pronounced pull forward related to the tariffs. Certainly not in the way that we did when we were facing labor disruptions on the coast and at the ports or on the rails, as we did in Canada. We saw some front loading of freight due to the risk of the Canadian rail strikes. So we haven't really seen that repeat itself for tariffs. I tend to focus more on the points that I finished the last response with. I think the uncertainty over investing in the market, investing in capital, is what ultimately is challenging for businesses. And I really appreciate your point of bringing up the election, because we tend to see slower macro environment
Hmm.
in the year of a presidential election anyway. But then you happen to have uh, policies that create greater uncertainty in the market. It certainly elevates the magnitude of uncertainty and challenges outlooks and strategies of investment even further for such things as equipment, tech investments.
Yeah, absolutely. Matt, let's shift gears for a few minutes over to manufacturing. January saw manufacturing actually grow, and by grow, I mean the Institute for Supply Management's key index, the PMI, when it's at 50. For those in the audience that aren't familiar, when the reading comes in at 50 or higher, that signals growth. In January, in fact, did come in, I think it was like, I can't remember. I don't have the number from me. I think it was like 50.2 or 50.4. But regardless of what the final number was, it's really serves as an encouraging, optimistic sign. And you're starting to hear a bit more positivity in regards to manufacturing slash industrial economy output. Is that an overreach to be early to be optimistic at this point, or do we still need to see more data, more evidence of signs of manufacturing turning the corner, in your opinion?
In my opinion, I'd like to see more signs of manufacturing turning the corner. To add some additional data, I brought up the advanced estimate of Q4 GDP. I mentioned we've had three consecutive quarters of increased durable goods consumption growth. So consumers are certainly spending more on durable goods than they had in time. It's had in some time in driving that increase in into the GDP figure. Uh, but from business investment and sentiment, and seeing a negative contribution of investment to GDP in the fourth quarter, I still think there's imbalance that exists in the market, and that's where the uncertainty is a little bit concerning to me.
Okay. Okay. And then when we look at sort of the state of inventories, Matt, we talked about this a lot in previous interviews in podcasts, and there was all types of different things. There was getting out in front of it, making sure you had ample inventories on behalf of retailers, for example. And then that was subsequently followed by what was viewed as sort of a major destocking of sorts. I guess with that as a backdrop, is a current inventory sort of flow, yin and yang, whatever you want to call it, is it in a better spot now than it has been before, or are tariffs and an uncertain the uncertainty kind of hampering that?
I would say it is in a better place. I think something that's helped considerably in the management of inventory has been more consistent consumption. When we look at longer term personal consumption expenditure growth on a monthly basis, pre-pandemic, we're looking at something like consistent long-term trend of 3.5% uh, growth.
Hmm.
We've only gotten back to that over the last 6 or 7 quarters on a more consistent basis. We're still trending a little bit below it, but just having consistent consumer spending and not the disruptions of a pandemic and an energy crisis following Russia's invasion of Ukraine,
Hmm.
having more moderate inflation, all of these things can't help but improve the management of inventories. And
Okay.
certainly there are challenges, tariffs being first and foremost in terms
Yeah.
of strategy that companies are going to execute in building, destocking inventories. But I think they're at a better place in terms of normalizing from major shocks.
Right. Absolutely. Um, it's interesting, Matt. I couldn't help but notice, and we reported on this last week, that aside from tariffs, aside from the election, a really big topic, especially in Q4 through the end of the year, was the East and Gulf I can't talk. The East and Gulf Coast port labor negotiations between the ILA and USMX. It looks like that deal is going to a ratification vote on February 25th with the expectation that it will be approved. It created a lot of uncertainty. Again, that word, it created a lot of confusion for industry stakeholders. Um, with the new 6-year deal presumably in place, effective on the 25th of this month, what does that mean for sort of supply chain stakeholders, and by extension, the supply chain slash logistics economy?
I think there's a lot of relief. We'll want to see the outcomes of all the deal concerning automation and um, ensuring that the U.S. port infrastructure can be as efficient as possible moving forward to accommodate economic and trade growth. But there's got to be a lot of relief in terms of having longer term certainty across the ports. Something that stood out in the data certainly was we had a shift back to the West Coast in terms of total port loaded container volumes. I think now with longer term certainty, in the Eastern Gulf Coast, I expect we'll return to the longer term trend and see that market share again head east. Um, but
Yeah.
I think there's got to be relief in it. At least you take that off of your checklist of various points of risk to pay attention to.
Okay, understood. And one thing I forgot to ask before, Matt, and I wanted to jump back to it because we were talking about tariffs regarding Canada and Mexico. Um, you know, Mexico, a lot of American companies obviously have major presences there from a manufacturing standpoint. Um, if they're to tariff the U.S., sort of to reply in kind, effect coming next month, when the 25% are expected to kick in, what does that mean for nearshoring? And I'm including Canada in this too. I just was talking about Mexico, but what does that mean from a nearshoring slash sourcing perspective? Is that going to force American shippers, manufacturers, retailers, etc., to have to make some hard decisions? Perhaps prematurely in a sense, or do they kind of stay steady and focus on whatever they're doing in those respective regions and just figure it out from there? I know that's wildly an open-ended question, but I think you know what I'm trying to say.
Absolutely. I point to the longer term trend. So our import volumes from Mexico have been growing considerably, especially going back to the financial crisis. And so it's hard to completely disrupt that longer term trend with just a single uh, uncertain moment in policy between the countries. I think I'm very interested to see how the USMCA agreement is renegotiated next year.
Hmm.
And then I think companies will make longer term considerations. But there has been a tremendous amount of investment. We've experienced at Breakthrough seeing client supply chains move and become more invested in Mexico than they certainly had been even 5 years ago. And so I think that's going to stay unless something substantially changes and it has a sense of permanence to it in that trade agreement.
Okay, understood, understood. Um, and then when we look at sort of some of the different modes, obviously that are for in the forefront within our sectors, truckload, rail slash intermodal, LTL. What are some of the things that shippers using those modes respectively need to be paying close attention to? For example, what is something that an LTL shipper is focusing on more so than a truckload shipper would? Or what is something that an intermodal shipper is focusing on more so than a straight rail shipper might? I mean, I think that might be just something our audience would like to hear about.
I think all of them care tremendously about the rate at which those respective modes of transportation will come into pressure with the appreciation that at some point here we're going to see an upward moving rate environment. I think in terms of trends across those various modes of things that really stand out to me, intermodal comes to mind. So we've seen coal volumes return to a longer term trend over the last 12 to 14 months. I think January was actually the first month of the past 12 to 14 months in which we saw coal volumes actually increase year over year
Hmm.
on the rails. They've been returning to a longer term trend, and our expectation was a permanent trend of coming off of the rail. This creates great opportunities for intermodal shipping, and we have seen intermodal snatch up this opportunity in January. Our intermodal traffic was up 9% year over year and now accounts for 54% of all rail carloads, at least across the class one data. And so it's the largest share that we've seen going back in that data since 2000. The expectation is that's the largest intermodal share we've ever had in the United States. Shippers are very keen in moving products to intermodal as long as service holds up, which has been a question in the past, but as long as
Yeah,
service holds up, they want to continue to decarbonize their networks. This is a very economical way to do it. And so intermodal is going to remain attractive moving forward. And quite frankly, the class ones need the intermodal volume to make up for the coal volume.
yeah,
And so I
yeah.
think that's one trend that really stands out to me.
Okay. And then, to take the intermodal point that you're making, just one step further, um, the better the consumer, is it fair to say, maybe Matt, that the better the consumer does or is doing, that the better intermodal will perform as well, in terms of results and increased volumes is and things along those lines?
Yeah, I think that's pretty fair in terms of what's being moved. And international containers definitely add to that volume. Um, so we do see that we had really strong West Coast port volumes in particular. That was definitely a boost to intermodal volumes and its growth over the course of the last calendar year.
Okay, great. And just to wrap up here, Matt, when we look, obviously we're almost through February here, shortest month of the year, so pretty close to the first two-thirds of Q1 already being in the books, which is kind of hard to believe. Um, how do you sort of view how things are going collectively within freight, logistics, macro, freight economy, et cetera, year to date here on February 20th, where the day of this recording? Are things where you thought they would be, or is are you kind of surprised that things are not where they are you thought they would be?
Yeah, excellent question. Trying to be succinct with this answer. I don't want to say our forecast was accurate, at least not be yeah, want to be a little humble about it, but I'd say of the surprises, we did expect 2025 to start slowly for the freight market. We thought that macro would be better than the freight economy to begin the year. We're looking out toward the middle of the year to start seeing more consistent growth especially in terms of freight demand and volumes
Hmm.
for both uh, and truckload and intermodal to grow consistently and ultimately create that eventual turn in the market. We don't expect we're there yet. One segment that's performing pretty well is at tighter capacity. Rates have gone up materially over the past few months is refrigerated truckload. But
Okay.
much of that's also attributed to regional dynamics that we saw in the Pacific Northwest with the intersection of produce season, ultimately putting pressure onto it. And then cold weather certainly contributed to maintaining that pressure in that respective market. But short of the refrigerated truckload movements, we're not seeing across asset-based carrier sizes, certainly not across brokerage. Uh, we're not seeing any sort of maintained momentum. And actually, as we have conversations with shippers through their RFPs, there are plenty of opportunities to come away with that RFP with by and maintaining and achieving their cost strategies. They're not receiving a ton of upward price pressure in those RFPs and taking on cost increases in this early part of 2025. And so I think one of the surprises could be that we've seen freight demand volumes be a little bit lighter, especially in truckload than we would have anticipated. But then our expectation was it's going to take time as 2025 goes on to really move the market and ultimately turn the market, both for demand and in rates.
Okay.
Um, and we know capacity is persisting in the market. There was an adjustment of employment figures from the Bureau of Labor Statistics that moved down the level of employment for long distance truckload, uh, long distance LTL, local truckload. But the long distance truckload employment figures are still above their January 2021 baseline that we set in a publication we routinely update. So capacity still lingers. It has come out in the market, but it still lingers. Ultimately, demand and capacity continue to progress simultaneously. It's not just one ever moving the market. So we're getting close to that point in which we'll start to see more pressure on rates, but we're just not there yet. And so just to spin around and try to summarize the answer for you, I've been a little surprised that freight demand has been as a little bit weaker to begin 2025 than we would have expected it. However, with the uncertainty, what it does to business investment, it really adds up. And then the expectation that freight demand, ultimately rates, won't really see upward pressure until 2025 progresses toward the middle of the year and uh, more pressure and upward movement in the second half of the year. That still holds up in our expectations.
Okay, great, great. All right, well, listen, Matt, that brings us to the end of our allotted time for today's podcast. So, on behalf of Logistics Management and the Peerless Media Supply Chain Group, I'd like to say thanks for joining us again for your third time.
Jeff, thanks so much for having me. Happy to have the hat trick on the evening or on the
Yes.
day of the Four Nations final. And maybe as one last forecast, perhaps if Canada wins tonight, the U.S. does move forward with that 25% tariff. Maybe if the U.S. wins, they play nice and don't move forward with the 25% tariff.
Yeah.
But for
Yeah.
everyone's sake, I hope the tariffs stay off the table.
Right, right. No, I hear you, and it will be one heck of a game, so that will be fun. And for those of you in the audience, if you want to connect with Matt, he is on LinkedIn, so you can go ahead and find him there. His last name is spelled Muenster, and you can also find Breakthrough, the company that is, also on LinkedIn. And Twitter. On Twitter, just go search for Breakthrough NA. And we're also on Twitter at Logistics Management, that is at Logistics MGMT. Also, if you're not signed up for our podcast, please go ahead and do so. Just pull up Supply Chain 24/7 wherever you get your podcasts, and it'll pop right up. Thanks, everybody, and have a great day. We'll talk to you soon.